We're taking a phased approach to the development of the Sandsloot Underground in order to preserve capital and progressively de-risk the project as we move through feasibility. The first phase, if it meets our capital allocation criteria, is a trucking solution which will support an initial production rate of roughly 2 to 2.5 million tonnes per annum. If phase B meets our capital allocation hurdles, we'll then expand the ore logistics infrastructure to include a conveyor system, allowing the mine to gradually ramp up to around 5 million tonnes per annum post-2030, unlocking the full potential from Sandsloot. The pre-feasibility study for the Sandsloot Underground project was completed during the first half of the year. The results confirm that the key parameters outlined in our Capital Markets Day remain intact. These include reef grades of 4 to 6 grams per tonne, significantly higher than other mechanized underground mines in Southern Africa, as well as a competent hanging wall and favourable mining width, with an approximate reef height of 45 metres. The image on the screen shows a cross-section of the reef intersection, with the white line indicating the high-grade contact with the reef to the left. All these characteristics make the ore body amenable to efficient, bulk mechanized underground mining, making Sandsloot a highly value-accretive growth prospect for Valterra Platinum. The feasibility study is underway and targeted for completion in the first half of 2027, at which point we'll be in a position to make an informed investment decision. We'll also continue to make solid progress on the development activities at Sandsloot. In the first half, we completed about 12.8 kilometers of underground exploration drilling and 1.6 kilometers of decline development. This brings the cumulative total of 43 kilometers drilled and 8 kilometers developed. Trial mining will also be undertaken over the next 18 months as part of the feasibility study, followed by a ramp-up to the Phase 1 steady state towards the end of the decade. Chinese buying has been strong across the PGMs, but most notably for platinum. Both imports, including metal going into Hong Kong, and the turnover on the Shanghai Gold Exchange shown here, have been elevated and accelerated throughout the first half. This appears tied to a recovery in Chinese jewelry market, which has struggled for many years. It's clear that there's been an uptick in interest from jewelers, looking for a better value proposition than gold. Chinese consumers will likely match this enthusiasm given new collections and the promotional campaigns which are currently underway. These developments have had a positive impact on pricing. Our realized basket price in the first half was about 5% higher year on year, led by gains in rhodium, platinum, and ruthenium. However, in July, so far, market prices for the basket have risen by another 20% on those levels, with rapid gains for platinum, which has hit an 11-year high, and ruthenium, which is now approaching a 2021 high. Despite the rally in the PGM basket price, we continue to believe that the current price levels remain below the thresholds required for operations to generate positive cash flows and to incentivize new production.
Looking ahead to the second half of the year, earnings are expected to be supported by stronger PGM prices, a planned step up in production, supporting higher sales volumes, and the achievement of the full 4 billion rand cost savings. Furthermore, the insurance claim related to the Amandelbult flood event is in progress, with an interim payment of around 1.4 billion rand expected in August. The total claim is anticipated to be between 4 and 5 billion rand before deductibles, the majority of which is expected to be received this year. We are on track to deliver the targeted savings of 4 billion rand in 2025, with 2.1 billion rand delivered in the first half of the year. The cost reductions delivered included 1.1 billion rand from labour and contractor costs, resulting from the flow-through benefits of the operational restructuring completed in 2024, and approximately 450 vendors off-boarded to date. 0.6 billion rand delivered from the optimization of consumables and efficiencies, benefiting from a total cost of ownership approach procurement, and about 500 million rand in corporate cost and other sundry-related savings. Our cash operating unit cost declined 2% from 2024 to 17,952 Rand per PGM ounce. This reflects our commitment to cost discipline. Including the Amandelbult flood impacts, the cash operating unit cost was 20,580 Rand per PGM ounce. Full year cash operating unit cost guidance has been revised to between 19,000 and 19,500 Rand per PGM ounce. We are confident in meeting the revised unit cost guidance as Amandelbult Tumela lower section ramps up and our operational excellence initiatives gain traction. The all-in sustaining cost for the first half of the year, excluding the impact of the Amandelbult flooding, was $962 per 3E ounce. The all-in sustaining cost at each of our operations, with the exception of Amandelbult, was largely in line with the prior period, despite the lower sales volumes, and each asset continues to deliver solid margins. All-in sustaining cost for the year is expected to be between $970 to $1,000 per 3E ounce, supported by the targeted cost savings, sustaining capital optimization, and higher sales volumes. Looking at the one-off demerger and separation-related costs in more detail. Total one-off demerger-related costs remain consistent with the guidance we previously provided of around 1.5 to 2 billion Rand for advisory costs, system separation costs, and corporate identity changes, and 4.2 billion Rand for the settlement of historical services provided by Anglo American. A large portion of these costs were already accrued in 2024. In the first half, we accrued a further 1.4 billion Rand. In terms of cash flows, we paid 2.8 billion Rand in the first half, comprising of 2.2 billion Rand to Anglo American and about 0.6 billion Rand in advisory and corporate rebranding costs. And in the second half, we anticipate a further cash outflow of approximately 2.7 billion Rand. We remain on track to deliver 1 to 1.5 billion Rand in annual post-demerger run rate savings, with around 1 billion Rand expected to be realized in 2026. These savings will be driven by the phasing out of transitional services arrangements, optimized labor structures, reduced overheads, as well as a more simplified operating model.